Hey traders, Raghee here. Welcome to another episode of Charts and Coffee. Welcome. Happy Friday, everybody. I know for me, I'm very interested to see how this Friday ends. I've got my eye on bonds, and let's kick this off with a quick look at the bond market. So that would be the ZB. There we go. ZB futures. And we want to see perhaps an inside day, a stall. In terms of what bonds tend to be saying is it's really a duel between the Federal Reserve and the bond market, two distinct opinions. The bond market on one hand is reacting to an economy that's going to be heating up a lot more than, say, Jerome Powell may have alluded to or even admitted to during the Humphrey Hawkins testimony Tuesday and Wednesday. And then also bonds are suggesting at the same time, yes, the economy is going to heat up and the Fed's going to lose control of the longer end of the yield curve. You add all that up together and you're kind of seeing this tantrum that's happening in the equity markets, whether that be the tech, whether that be S&P. The couple of places that are handling this pretty darn well are I would say the Dow, IYT, XLI, definitely XLF. These are handling this well because, one, we've got the reflation trade moving on right now. Copper, crude continue to go up. That's going to inordinately benefit the Dow more so than the NASDAQ or the S&P. And then you've got financials, which are benefiting from this environment with, just generally speaking, a little bit of sector rotation. You could say the same thing about energy. So that's kind of where we sit. Now, I kind of jokingly retweeted something on my Twitter feed the other day. It was something along the lines of, "Don't worry, next week we'll be rallying on stimulus hopes," and it's only slightly mockingly, but also true. How soon before the market realizes that the Federal Reserve very clearly said they have no plans to increase rates anytime soon. Bond market, bond action is casting doubt on that. I mean, that's the duel we're seeing right now. I wouldn't bet against an uptrend. I wouldn't bet against reflation. And I sure as heck wouldn't bet against Jerome Powell, because at the end of the day, people say there's a lot of wisdom in what bonds do and say, and I don't doubt that. One of my first mentors was a bond trader. That's a multi-dimensional market. I mean, smart traders in that market. But at the same time, I think really Tuesday and Wednesday, if anything, Jerome Powell established was really simply this: my bazooka is bigger. And if we believe that, it's hard to bet against the equity markets recovering, rallying. So right now, all we can do, and this is a really important point, and this is something that I was discussing with the folks in the Sector Secrets Mastery yesterday, which is, when you feel like, you have good trades that are in zones with proper structure that you can take advantage of, but at the same time, you're hesitant, and rightfully so, to want to get in, reduce your position size and move your entries to more moderate or conservative parts of your zone. So I always look at zones in three levels: aggro, moderate, and conservative. And in environments where we know that this could be the pullback that rallies higher. I mean, we've seen this not even a month ago. So if this is indeed that type of pullback, even if this market goes to more oversold instead of just merely a retracement, if that is that kind of market, it's our job as traders to find the relative outperformers and perhaps just engage them for more conservative levels with smaller size, and that's kind of what I'm persisting in doing. All right. Okay. So let's move on to some questions here. Hey there, James. How you doing, friend? Good morning. Did we miss the entry on WSS I meant to ask in the room. So yeah, I was looking at WSM as a potential breakout. I don't think so. And the reason I'll probably, James, one of the reasons I'll probably say meh to Williams Sonoma is that when I think about where Williams Sonoma sort of exists within the passive investing, the ETF world, where it's heavily weighted, and I don't think I have ETFDB up right now, but when you take a look at the holdings, I like ITB and XHB going higher, and then I'd just like to find relative outperformers in that space, right? That's really what I'd like to find. So there's a lot of things we can look at, but I think I'd rather focus on now. I don't mind Williams Sonoma. I mean, hear me out. I definitely don't mind it. It's gone sideways. It's more volatile. It'd be better for a breakout, but I don't think so, my friend. I don't think we did. All right, next up. Hey there, editor. Good morning. What's puzzling? It's puzzling that the market sell off after the Fed chair says they're looking to keep policies the same. Do you think other things are at play? Yeah, and thank you for the question. And I would just sort of say, yeah, what's at play is they don't believe him, or they don't believe that he will be able to do what he says, or they don't believe their forecast. There's doubt, right? I'm not saying it's anything more than that. And the doubt is being cast. First, it was by the Fed funds rate, which has actually come back into line. I think we talked about that either in a Charts and Coffee episode or in a recent free video that I do for Simpler Futures, the way in which the Fed funds rate was reflecting what Powell may have to do. After, to your point, editor, after the 2 days of testimony, that Fed fund futures expectation for a potential 25 basis point hike did come down almost in half. So that part was successful, but bond traders said not so fast. And that's, I think, the duel we're seeing right now. And again, if you take a look at that ZB, if I'm going to trade TLT, gang, I will do so only after looking at ZB. And let me mention something about ZB. I'm not saying that in any way it suggests what's happening. And keep this in mind, because the markets are a funny thing. We know this. Why now? Is it because we're approaching certain percentage points in terms of there are always thresholds at which we think the market is going to suddenly say, I don't want to be in stocks and I need to be in bonds. And those thresholds are typically going to be when the, let me go on over here. Let me show you one other site. Do I have it up? Because this is important, and I get a lot of questions about this. Why suddenly now? Because anyone who follows my work will say, Rog, we've been in a downtrend, and a zippy one at that, in bonds for a while. So why on earth is everyone suddenly now so concerned about the increase in rates? And the direction in bond futures and the increase in rates, clearly, as you can see, they're inverse. Okay, so as bonds move lower, the rate is higher. So. And I'm trying to keep this without getting really super technical, but I think there's a lot of truth to this. When we start to have the 30-year crossover or the 10-year crossover, certain they're completely subjective thresholds where we say, oh, wait a minute, at 1.5 or 2.25, just like 30,000 Dow. Why is not 29,000 important, or 29.9? There are certain psychological thresholds that when we cross, it just seems to be a tripwire for subsequent reaction. It just sort of gets the dominoes going. And that's what's happened. It's not that bonds have not been in a downtrend. Bonds have been telling the same story for quite some time. And why do I say that? And how do we measure that? Let's go back to the chart. We've been double red in bonds since January 12. Well, if you take a look at the overall markets, they haven't been in a downtrend. So why suddenly now? Because of now the yield has become attractive enough where the market's stepping back and saying, wait a minute, could this now be a place where people would migrate their capital to? I hope that makes sense. And it's really basic. It's a really basic thing. I don't think it's a super complicated concept. I think a lot of you say, well, yeah, that makes perfect sense. And, we get why now it might be more attractive. As far as the gap, so I don't consider this a gap, Rick. Thank you for the question. And you're right in that this is a gap that a lot of people would, it's half of a gap to me. So let me make it clear as far as what gap psychology is for me. It's a two confirmation process, not just opening above the prior session's close, which you're absolutely right. We are, and there's going to be a certain segment of the population that may fade this gap. Now, what do I mean by that? For those of you that don't know, I know you know, Rick, because if you're asking this question, I know you know, but that means that when the market opens up within the first 1 to 3, maybe 5 minutes, there'll be a range set. And you'll have certain traders, day traders, that want to short a gap up. Same thing on the other end of the spectrum. A lot of folks want to buy a gap down. So when you have what I call half a gap, we're opening above the prior session's close. We're opening above the prior session's close. I actually like to see a dual confirmation gap, which means that I want to see the market open above the close and open above the high. I think, don't get me on the lingo because I try not to get hung up on it. Half the words that I use tend to be just words I've used because I'm 98% self-taught. I think it's called a true gap, perhaps. It might be called a true gap. And I think those have a higher probability of being faded. All right. So thank you for the question. All right. Line Watcher says, no question today, but have a good weekend. Thank you, my friend. Thank you, my friend. I appreciate that. All right. So next question, Jonathan, if you were in stock, would I hedge my position or simply wait? So huge question. That could be an entire episode, my friend. So let me give you as sound advice as I can in a Cliff Notes form. What I don't know is whether we're talking investing or trading. In investments, I don't purposefully hedge. But, if you're using a 60-40 portfolio, 70-30, you've got things that are designed to maybe tread water, maybe even lose value when the larger part of your portfolio is benefiting. So, I'm not a huge fan of hedging. In fact, I don't like it at all for traders. For investing, completely different conversation. But to me, hedging, again, is not something I even do. I manage 5 portfolios and I don't hedge in any of them. I just diversify. They'll benefit from different macroeconomic cycles. So I think about what cycle we're in now, what cycle could we be going in, and I may front run the cycle by having a little bit more exposure there. So I'm not hedging. I'm just thinking about what sectors, what asset classes will benefit as we transition from macroeconomic cycle to macroeconomic cycle. All right, so there's that. And then as far as traders go, I find that traders who tend to buy near the tops of ranges tend to buy breakouts, more momentum, which is fine, have to hedge. But look, I think hedges are simply this. If you're going to market time your hedges, well, that's almost sometimes as futile as trying to market time anything, right? I mean, now you're trying to guess at the top and where the market pullback will be. Talk about jumping through hoops lit on fire. So either you're always in a perpetual state of hedging, meaning you just wear your seatbelt when you're in the car, or you've got a particular setup or a particular reading in the markets that tell you now is the time to hedge, which really is a setup, right? It's really a setup that's a fade of new highs. So I don't think about it as a hedge as much as, hey, would this be a setup that suggests, based on whatever your indicators are, whatever your strategy is this a level at which I think the market could pull back, could contract, could retrace? And if there's a setup there, and then the strategy is therefore the hedge, great, but I won't ever call it the hedge. It's a strategy at which I'm looking at a bearish play. All right, that's one way to look at it. And then the final way to look at it is same scenario, whatever indicators you've got. Maybe it's, for me, it might be the standard deviation of my volume weighted average price is just up at a +2.5, +3. And I know that bungee cord is pretty extended. It's ready to come back. Or maybe you're using ATRs and you're at 2 or 3 ATR and you realize, hey, historically at that 2.5 plus ATR, the market has a habit of snapping back. Whatever your setup is, I'm just giving 2 very popular examples. I use a standard deviation of VWAP. You can even couple that with a standard deviation of ATR. So when you get to that bungee cord, now it's stretched out, what I like to do is just be more conservative about my entries and also reduce my position size. Because if I still have a trend in play, I'm still playing directionally. So I don't want to necessarily abandon those types of trades. I just might be more conservative about it. I might be much more cognizant of the potential higher risk for the pullbacks. I hope that helps. I don't know that I've ever actually given anyone those scenarios before, but that's the way that I process this. And I'm not a fan of what people would traditionally call a hedge. I'm a fan of looking at that as a setup, as a market that's become extended, ATR, or volatility via PMRs, even the VWAP that I mentioned. How many standard deviations from the mean are we? And if we, again, think about a bungee, if it's ready to snap back, well, now you can start thinking about where a short position may be, or maybe where that strategy could take you, since the likelihood is higher. But anyway, I don't want to get too far into that, but that's the way I look at that, Jonathan. Not a fan of traditional hedging, but I get the inclination of, hey, what do I do if I think the market's a little overextended? Remember that all uptrends look overextended. So let me just wrap this question up. And it's one that I get a lot, and I probably have a slightly less orthodox, although most of my trading isn't, but I have a slightly less orthodox way of looking at it, which is, well, if you're hedging, then what's the difference between this and this? Or this and this and that? Probably nothing. So the thinking that I'm going to get the hedge right here and it's going to be great, versus I'm going to get the hedge right here and wow, I'm so thankful. What's the difference, right? You're going to notice that most of the time they look alike. So that's why I said it's got to be almost like a habit, putting your seatbelt on. So rather than that, I'll just think about reducing position size. That's my seatbelt. All right, thank you for the question. And again, a popular one at that. Let's see. Hey there, Rolex. So looking forward to March. February is, where is my, yeah, February can be seasonally tricky. But look, to hang your hats on seasonals only, gang, see, this is what seasonals don't know. And anyone who just wants to point at seasonals, it's an incomplete look. It's amateurish. I love seasonals. I not only look at seasonals, I look at intraday seasonals. But to only just say, well, this was just a seasonally tough month. Look at most of February. It moved higher. At the end of the month, nearing Humphrey Hawkins' testimony, nearing certain bond thresholds. Again, we talked about how bonds have been moving lower since January, and the market's been moving higher. Since January 12, bonds have been moving higher, right? Had a bumpy end of January, had a bumpy end of February. Again, bonds reached a certain threshold. So yes, it might overlap with the seasonal. We know that probability is out there, but what's the setup? What's the trigger? What instigates that? And I think the catalyst in this case was just an economy that continues to heat up, coming into the crescendo of the Humphrey Hawkins testimony, and the bond market reaching certain thresholds that, while it's been selling off, finally has got to a level at which it's got attention. So yeah, I think a lot of times people will just kind of say, oh, well, it's a seasonally tough month. It really wasn't. It really wasn't until the bond market started to cast doubt on the Fed's ability to control the pace of the economy. No one's doubting it's heating up, no doubt. What's my favorite? And thank you for the question, Sachin. What is my favorite book on macro investing? My favorite book on macro. I'm looking back at my bookshelf here. I really have liked, The Holy Grail of Macroeconomics is a really good one. The Holy Grail of Macroeconomics. You can pick that up at Amazon. That's a good one. And then that one actually is more applicable to where we are right now within the cycle of macroeconomics in the U.S. Oh, actually, how can I forget? Ray Dalio. Ray Dalio has a book set, and I've got on my desk the very first book within a 3-book set that Ray Dalio had on the debt cycle You can I think he makes the download available free via PDF. That's a good read too. But just the first 80 pages, the first booklet of that multi-book set, that's a good one too. But remember, again, in terms of pillars of macroeconomics, remember, macro guys have gotten the market wrong for the last 5 years. And certainly the last 3. They've been jumping up and down on their tables talking about why the markets should head lower. And a few times they did. But when the Federal Reserve said, I am macro, and they're right. When the Federal Reserve changed policy, the Federal Reserve controls the monetary policy, the money supply, and that in turn, influences GDP and inflation. The Federal Reserve basically said, I am macro. And that's where you saw things like, look, macro funds like Dalios, they got punched in the mouth because they refused to accept that this current Federal Reserve is really disrupting business cycles, debt cycles, and generally speaking, macroeconomic cycles at a level never before seen. So I'm a huge fan of understanding macro phases. I've talked about it, but don't let it be confused with timing. It doesn't offer it. And don't let it be confused with the fact that I guess the duel that bonds and the Fed are having right now is who's going to win. Hey, I'm always going to bet on the Fed. It's a bad idea to bet against them. I've done it before. It cost me money. So that's kind of where I say, just keep an eye on what the Fed does and their messaging, because they might be wrong, but they're going to have to, get the market prepared for any adjustment that they would have, whether that's a taper or a tightening cycle. And either one of those is going to create an absolute, tantrum. Okay. So thank you very much for that. Any thoughts? Last question here. Thank you for the question on the macro. I just saw this one, PLTR. And I got a lot of questions on PLTR. So this is a Kathy Wood favorite. It's hard to bet against an ARK name. They're buying Tesla, they're buying PLTR, but structurally, again, I'd keep an eye on purchases that are made from huge ETFs, funds like what ARK Investment is, but structurally, it's really more of an oversold type setup. The same thing goes with Tesla. It's more of an oversold type setup. All right, look at the volume that we ran into right there. Okay, and I'm just trying to find my clock. I blocked it with my coffee mug. All right, we got to wrap up. Sorry, I ran over, gang. So I will see you all, I believe, in the options room later on today. I think so. I'll have to double check the schedule on that. I will be in the futures room later on today. And my sector secrets folks, we have our weekly Q&A. And it should be an interesting one. We're going to talk about position sizing in the sector secrets mastery. You can join me over at simplertrading.com/sector if you're curious about what we're doing there. And then I'll see you guys in the futures room as well later on. So thanks as always for being part of the Charts and Coffee crew. And for those of you that aren't part of any of the Simpler services, check out a trial or at least catch the free newsletter that I have. The current issue is the 2 Canaries in a Coal Mine over at countdowntrader.com. All right, gang. Have a great one. Have a wonderful weekend. And I'll see you next week. Be good to each other, gang.